Okay, so hi everyone. We're going to learn about absorption and also variable costing in today's class. So basically, absorption and also variable costing is used to measure income. But what is the difference between these two? Okay, so we'll start with absorption costing. So absorption costing basically is um, the condition where the all manufacturing costs they are assigned to products to one products or to one product or the same product. So all of the manufacturing costs they are assigned to that product. Right here we have that the fixed overhead is equal to product cost, which means fixed overhead is counted as the product cost. And what is product cost actually? So product cost they consist of direct materials, direct labor, variable overhead, and also fixed overhead. Meanwhile, what is not included in product cost is called as period cost. So in period cost, we have the cost that occurs in accounting period and don't stick to product cost. So the costs that are not included in product cost basically, and it's usually administrative expense, selling expense, and also fixed overhead as well. Okay. And next we have variable costing. So variable costing is to measure income as well, but right here they only assign variable manufacturing costs to products. So only the variable manufacturing costs are assigned. Okay. The next one is the fixed overhead. They are seen as period expense. So they are not seen as the product cost, but it's calculated as the period expense. And remember that variable costing, they are excluded from the product cost, okay? Because it's variable. But it's not the same as variable overhead, okay? Because variable overhead is still needed in your production. So right here we still have the product cost, which is direct materials, direct labor, variable overhead. Meanwhile, for period cost, we have administrative expense, selling expense, fixed overhead, and also etc. Okay, that is for absorption and also variable costing. In this module as well, we will learn about inventory management. So what is inventory management? Inventory management or inventory cost is so we'll learn about inventory management and the inventory cost. So the cost that related to inventory management. And we have three things that you need to know in order to have your inventory management, which is the first one is carrying or holding cost, which is the cost that you need to pay to keep your inventory. For example, warehouse rent expense. So let's say you have inventory, you need a place to keep it, you need to pay a rent for that warehouse. And that is why it's called as carrying cost. The second one is ordering cost. Basically, this is the cost that you need to pay in order um, to make order for your inventory stocks. So for example, it's a freight cost. So let's say you buy inventory, that is your inventory cost. But your ordering cost is your freight cost. Okay. The last one is shortage cost. Shortage cost. So shortage cost is the cost that incurred if the inventory is insufficient for production. Let's say you need to produce for 1,000 water bottle and you don't have enough, and that is what we call as shortage cost. Okay, and in this module, in this inventory management, you will have some terms that you need to know in order to do the problems later on, and for your to deepen your knowledge basically. So the first one is we have carrying costs, which is usually given in the problems. The second one we have annual carrying costs, and for annual carrying costs, you need to calculate that with CC or carrying cost times with EOQ. EOQ is economic order quantity, and then you divide it by 2, and you get the annual carrying cost. Okay, so carrying cost is the cost to keep the inventory. The second one is ordering cost. Ordering cost is usually given in the problem as well, and the thing that you need to find is the annual ordering cost. Annual ordering cost is D times with CO or ordering cost divided by EOQ or economic order quantity. So D right here is demand or required units. Okay. And then the third one is total annual cost. So the total annual cost basically is just adding your annual carrying cost plus with annual ordering cost. Okay. The next one is we have economic order quantity. So economic order quantity is the purchase order size of inventory that's most economic. So let's just say that you need 1,000 materials for producing your water bottle, and the minimum size of you to make order is 1,000. Why? Because it's the most economic one. Let's say you order only 500, it'll be more expensive and it's not economic enough for your production later on, and it will make the price maybe even higher. So it's not um economic enough. Okay. For the second one, uh economic order quantity is usually used uh to set the par, like how much should they order in time. Okay, so the formula is square root of 2 times d times co divided by cc. Okay, so d is demand. Okay, if I don't write the difference formula, the difference in the explanation, then it's the same one. Okay, the next one is reorder point, or usually we call it R. So R is counted with D times L plus with SS, or safety stock. Yeah. Okay, so reorder point is point where company needs to reorder stock to prevent stock out. Let's say that the company has 20 stocks right now, and the reorder point in the system is okay, if our stock is below 50, we need to reorder soon. Or, okay, the reorder point is, let's say, it's 100. So if it's 100 already, it's already reorder point. Okay, so it's already, we need to order the stock immediately right now, because if we don't do it, then then our inventory can stock out. As simple as that. And then the D is demand or required units per days. Okay, so we count it as per days. If you're given in a year, then you need to divide by 360 or 365. And then the lead time is the waiting time since inventory ordered to delivered per days. Okay, so the waiting time since you ordered until it's delivered to you. And then the SS or safety stock is in units. The next one is safety stocks or SS. It's D minus with RU, or required units, times by L. So safety stock is the excess inventory stock to anticipate stock up. So reorder point is where you have your minimum inventory, and safety stock is that minimum inventory. If that makes sense for you. So in order to not going up more than your safety stock, you need to reorder. Okay, and that is why we need to calculate the SS first to can so we can calculate the R. So D is this one is different. So from just now, D is demand on required units. For this safety stock, the D is expected or maximum demand in units. So it's the expected demand that the demand that we need. Okay. Minimum RU is the required units to produce. Okay, so we need to minus it, and we know how much is our safety stocks. And then L is the lead time, so we can know the waiting time in per days. The last one is number of orders placed, and usually it's abbreviated as hashtag of orders. It's like it's how many times company need to reorder inventory in a year. So we need to know how many times company will reorder their stock in a year. So it's basically D divided by EOQ. The D is different because it's expected demand per year. Okay, so per year. And the EOQ is still in units. Okay, so basically, if you only learn by me talking, it's very impossible. So the thing is, you need to learn by problem. So we'll just go right into the problem. Okay, so in problem 5.1, we're going to learn about the absorption and variable costing. So right here we have Overny Company. They manufacture towels for well-known hotels. And in March 2022, Louise they began to produce the towel. And during the month of December, 50,000 were produced and 35,000 were sold at $10 each. Okay. The direct materials are stated as below: direct labor, variable overhead, and fixed overhead. And a selling commission of 5% of sales were was paid, and that all administrative expenses are fixed, amounted to 50,000. Okay, the first one is we need to show the difference between calculation of product cost using absorption and also variable method. Second one is to calculate the unit product cost, the cost of ending inventory using the absorption and also variable costing. Okay, and then we have like the third one is what is the contribution margin per unit using variable costing, which is the based on number two answer. Number four, company believes that the tower will really take off after 1 year of sales. On the other hand, management thinks December 2023 sales will be twice as high as December 2022 sales. Prepare an income statement for December 2023 using the assumed higher level of sales. And which costing method should be used? Absorption or variable? Okay, so that is problem 5.1. So the first one to start off, we need to find uh, the difference of product costing using absorption and also variable method. Okay, so the first one is we're going with absorption. Oops, absorption. Okay, for absorption, um, remember that we have the product cost and the variable period cost. So the first one is we need to find the product cost. Okay, so that cost, we have direct material, direct labor, variable overhead, and then fixed overhead. And the total will have the total. Okay, so direct material is 60,000, direct labor is 8,000, variable overhead is 10,000, and fixed overhead is 35,000. And the total cost is the total of those three, basically. Those four, sorry. So it's 113. Okay, and we got it for the absorption. For the variable cost, it's still the same. We're just going to copy paste this one. Variable. Okay, the product cost, we need to eliminate the fixed overhead. Because why? Remember this? That the fixed overhead is seen as period expense. So, yep. Right here we have the difference of product cost in absorption and also variable cost. Okay. The second one is you need to calculate the so number one is done. Okay. Number two, calculate the unit product cost and the cost of ending inventory absorption using absorption and also variable costing. So number two, we have the units produced. All you need to know, which is this 50,000, and it's still the same for this one, the units produced. So the cost per unit is just divide 113 divide by 50. As simple as that. As same as this, 78,000 divided by 50. We get 1.56 and 2.26. Okay. The last one is we have the cost of ending inventory. Okay. So for ending inventory, I need to know the ending inventory first in order to do the calculation. So to find ending inventory. So ending inventory, basically you just need to, it's as simple as production minus with sales, you get the ending inventory. So you produce 50,000, you sell 35,000, right? And you get your ending inventory 15,000. From where the 35,000? It's from here. 35,000 were sold. Okay, so we got that one, and we got the ending inventory. How much is ending inventory in cost? So you just need to times the cost per unit times with the ending inventory right here, and you get the amount the same as this. Yep, and you get the amount. Okay, for the ending inventory. And we're done with number two. Number three, the contribution margin per unit. So contribution margin per unit. Okay. The formula is, sorry. Okay. So contribution margin, the formula is um it's the same. So we're going to use the variable costing only, remember. So we have price times with variable cost per unit. Okay, so for price, the first one is we have the price is how much how much the product is sold. So we have $10 right here, right? We sold for $10 each. The variable cost is $1.56 based on this, right? But remember that because they are going to find the variable cost, we have another variable cost happening right here. It's not only this variable cost, but also another variable cost, which is your selling commission of 5% of sales. Okay. If you ask why are the administrative expenses not included, because it's fixed. Okay. As simple as that. So fixed and also administrative expense. So we only need to calculate the selling commission one. The selling commission one is 0. So it's 5%, right? So 5% of sales. So 5% of sales. Okay? Like this. 5% of sales. Because we are going to find it in unit. That's why we are trying to find it in unit as well. Times times. Okay? So we just need to calculate it. So 10 times 1.56 plus with 10 times 5%, and we got 20.6. Oh, sorry, this is minus. Sorry. Minus. Sorry for that. We had, yeah, 7.94. Okay, this is the contribution margin per unit. Continue to number 4. They believe that the towel will take off, right? So we actually need to know how much is the products produced. Okay, so the first one is they told us that the sales will be twice as high as December 2022 sales. So to predict that, um production, so 2023 production The first one is production. Is they said twice, right? So 50K times 2. Paste this. So basically, this is 2 times. And the sales is also 2 times, right? So the ending inventory is 30,000 basically, because that is the formula. Then continue, they call us to find the income statement with assumption that is higher, with absorption and also variable costing. Why? Because we don't know which one is better. Like we need to know which costing should be used. So we need to do both of them. So just make the income statement right here. So the format will be easier. Okay, the first one is so this is number 4. We just need to write the name of the company first, which is Auburn Company income statement for the year ended December 2023. Remember. Okay. And then the first one is we have absorption. And right here we have variable. Okay. First one. In order to make your statement, income statement, we have sales, we have um, COGS, and then we get the gross margin. After that, we will minus it with our uh, selling expense. And then we have our administrative expense, and we get the operating income. Okay, so the first step is this. Then we'll just go right into it. For the sales, as this is expected, okay, so remember production, oh sorry, the sales times with $10. Why? Because it's in unit right here, so it's you need to take the dollar basically. You need to times it with $10. And then we get another one is the COGS, or the cost of goods sold. Okay, for the cost of goods sold, um we need to find it, okay, which is the cost of goods sold is your sales times with your cost per unit. Yep. So your sales, right? And you times it with your cost per unit. Why cost per unit? Because it's your basically it's your cost. It's your cost for selling that, but you times it with your original, what is it? And original cost. Okay, so you sell it for 10, but you produce it only for 2.26. And then we calculate them. We got this, and then the selling commission is 5% of your sales, so 700 times with 5%, and we got it. The next one is administrative expense. They are fixed for 50K. And then we get the operating income, which is calculation of 3 of this, and we get 456,800 for absorption. For variable costing, it's I just copy paste this one, okay, but we have some additional because of course it's different. So the first one is you need to find the variable in everything. So one is, let's just move it here. So in first one, you have COGS, but your sales and COGS is still the same. Sorry, the COGS is different. It's 70,000 times with your cost. So the cost is different. Okay. The second one, we have anything that is related to the variable, basically. So we have our variable selling expense. Remember, we have our variable selling expense, which is 5% of selling. Okay, and we get the contribution margin, which is 550. Why it's contribution and it's not gross? Because we still have the fixed margin, fixed costs. Okay, so the fixed cost, another one is of course administrative expense. Move it here, and you have your fixed overhead of 35,000 that is not included. Okay, so minus with fixed overhead, which is 35,000. Okay, so your operating income is, and right here we can see the income that is generated by the variable is much more. And that is how we conclude which costing that we should use for this method. So right here, they ask, right, which costing should be used. So the answer is variable costing. So right here, variable costing method should be used in order to generate higher income. Okay, so this is the answer for number number 4. Okay, and we are done with problem 5.1. Next one is problem 5.2, which is variable costing only. So I hope you understand in problem 1. In problem 2, we are going to continue, which is Heheheha Inc. They are a manufacturing company which produces table and chair. And this year, the company produced 40,000 tables and 60,000 chairs. The additional information are as follows: selling price per unit, variable cost, direct fixed overhead, beginning inventory, and then we have ending inventory, variable selling expense per unit, remember per unit, direct fixed selling and administrative expense. Okay, we got it here. And then the common fixed overhead for the factory. Common fixed overhead for the factory was estimated to be 110. Remember that it's estimated. And the common selling administrative expense estimated to be 50,000. Okay, so we're going to find we need to prepare the segmented income statement for this year using variable costing only. And what is the effect, okay, on their profit if the company drops the production of table or even chair? Okay, the first one, we need to find um we need to do the income statement. But in order to do your income statement, you have some steps before that, right? The first thing is, of course, you need to know how much is sold, because they actually didn't give us how many, like they only start about the selling price, but they don't say that how much is the sales. Okay, so the first one is we're going to find it first. Right here, we're going to find it in production and then plus with beginning inventory minus ending inventory, and you get your sales or units sold. Okay, so basically it's just like this, but we didn't know, so we need to find the ending inventory first. And yeah, we need to find the COGS first in order to know how much they have sold. Table, and this is for chair. Okay. Production, they produce 40,000 for tables and 60,000 for chairs from here in units. Beginning inventory is 45,000 units and 55,000 units for chair. For the ending inventory, it's 25,000 and it's 35,000 for chair. Okay, and in order to find that, we just need to calculate by adding all of them. And we get 60,000 and also 80,000 for the unit sold. Okay, the next thing we're going to do is to make the income statement. So for income statement, I'm just going to copy paste this one. Yep. We are going to okay. So we have variable costing. And right here, remember that we are going to find two of them, which is, oh, sorry. Uh, so this is table here, and this is the total. Yep. And the time is for, they didn't write the time, so ended December. X for 20 X. Okay. Ink. Yep. Perfect. So the first one is the sales. So for sales, basically, we are going to find this. Sales for table and chair. Sales for table is 60,000 unit times with the selling price, which is $45. Okay. Let me. Oh, sorry. 1,000 times 45. Okay. For chair, it's 80,000 times with $30. For the total, just add both of them. Okay. The next one is the COGS. And remember that this is, I'll just add it, okay, variable. Which one is the COGS? So the COGS is basically three of this. So the cost of goods sold, it's as simple as you take your sales unit times with your variable cost per unit, which is $25. And we got that. Okay. So this one as well, times it with your $20. Yup. And we can calculate that. Next one is we have the variable selling expense because they wrote it down here, the variable selling expense per unit. So per unit, you need to times it by this sales unit per sold times with $10 for table and $15 for chair. And again, we calculate that. No, this one. And we get our contribution margin. Sorry, the minus. Okay. And then we just need to calculate them. Oh, sure. Wait. Yeah, we just need to calculate them. Adding 3 of this. Okay. Do I miss something right here? E6 times with 15. Yep, it's correct. Oh, wait. Um, variable expense per unit. Per unit is 15 for a chair. Yep, make no mistakes. Okay. Um, alright. Well, let me see for a while. Okay, let's just put it that way. Okay, and then we have to fix overhead. Wait for a minute. I'm just going to check it right away. Okay, I'm so sorry that we need to change the amount. This one is $5. So change it in your module as well. It's $5. Okay. So right here we just need to change it to 5. And yep, we got it. And then the fixed overhead right here, we have the direct fixed overhead, which is 120. Okay. And also 70,000. Okay, so 120 and also 70. And then we have our administration expense fix. Okay, so fix selling and administrative expense, which is right here, it's 75 and also 45. And yep, and right there we had our segment margin. So for this segmented only, this is actually our income. But remember that they told you that the common fixed overhead and the common selling administrative expense, you need to count that in order to find your um, operating income. Okay, so we have common fixed overhead and also common selling and S&A expense. Into no. Okay. We get this one is 110. This one is 50,000. And you need to add 3 of them. And then we get the operating income. And we are done. So this is the operating income um, for the year. And remember, why do we need to find the segmented one? Because they are They asked to find the segmented income statement. And the second one, what is the effect if they drop it or what if they drop one of the production? So in order to find what if they did drop the production is, you need to find your income statement, basically. So why do we need to find it? Because we need to see what if we drop this one. Okay, so taking the same one as this one. Okay, so this one is segmented income statement for chair. So this one is for chair. So in this case is, oh sorry, if table or if drop table. Okay, this one is if drop chair. Okay, okay, so basically right here we just need to copy paste everything that we have done just now. Okay, so the first one is, because this is voucher, so I'm going to delete this one. I'm just going to take this one. Okay, and then this one as well. And yep. So just select this from here. Oh, sorry. Then your command fixes this. Mm, yep. So this is your income if you drop the table. So just taking the same one from here, but you just need to add both of this. Okay. This is if for chair. If drop for table. Okay, wait, let me. Okay. What if we drop the table? Guess I can move this one to here. Yep, looks better. If drop chair. So this is for table. Okay, it's still the same. Take it, take it, take it. Take it from here, take it from here, from here, take it from here, and we get 245. So right here we can do our um calculation already. If they drop table, they will only make income for 125. If they drop chair, they'll only make a profit of 245. But if they dip both of them, they get 530. Okay, this is for problem 5.2. Next one is problem 5.3. Okay, so problem 5.3 is the one that inventory management. You're going to use all of these formula right here that I've told you before. And right here we have that the Antoinette company, they produce smartphones and provide services. So STN is a component that is used as a part of the smartphone. And each year, 20,000 units of part STN are used. Cost to place an order is $80 and the carrying cost is $5. Okay, remember that this is per unit. They are used at the rate of 100 parts, but some days as many as 100 parts, 120 parts are used. It takes 1 week from the time to order to the time of arrival. So this is the lead. Okay, the first one is calculate the EOQ, how many orders per year under EOQ policy, annual ordering cost under EOQ, what is annual carrying cost, and then total annual inventory, reorder point, amount of safety stock, reorder point with safety stock. Okay, the first one. Um, I think I missed out a formula, but it's okay. I'll just go with it later. So the first one is we need to find the EOQ. EOQ. EOQ is economic order quantity. Okay, if you forget about the terms, just go back and see. So it's this, okay, right here. So, okay, before we are going to do that, we need to insert some information first. The first one is the carrying order is ordering cost. Okay, usually it's given to make orders for inventory stocks for the freight. Okay, so CO right here is the CO is um $80. Okay, CO is $80, and then the produce units or D right here. D is for demand or required units, which is 20,000 units. The carrying cost is $5. Okay, so right here we just need to insert that the EOQ is the square roots of this, right? So the square roots, how do I um yeah, okay, I'll just use formula. Can I just no, wait. Oh, need to insert some equation. Yeah, this is it. 2 times with the D is 20,000 times with the CO is 80 divided by CC is 5. Okay. Yep. Okay, this is the EOQ. And we just need to calculate them. Wait a minute. Okay, wait a minute. Okay, and then we will need to calculate the square roots of the EOQ. So basically, we just need to insert the formula. Square root, I guess. Yep, square root. If you're using Excel, it's easier, but if you're using manual, then you need to calculate it carefully. 80, okay, divide by 5. Yep, and we got 800. Okay, for number 2, it's how many orders per year. So it's the number of order. Okay, go back and see the formula, which is D divided by EOQ, but it's the expected demand. Okay, so okay, um, D divided by EOQ. Okay, right now we don't have any expected demand or whatever, but they only say the 20,000 units part are used, so we're going to use that right now for now. Okay, so this is 20,000. This one is 800. So we just divide it, and we got the amount of 25. Okay, this is the number of order per year. Okay. Um, okay. Number three, we have that is annual ordering cost. Okay, annual ordering cost or CO. Okay, annual CO is this. Okay, paste, taking the formula D, which is 20,000 times with CO, it's $80, right? Your EOQ is 800. Okay, so the calculation is 20,000 times with 80 divided by 800. And we got 2,000 per year for the annual carrying cost. Number four is the annual carrying cost. Oh, sorry, that one is ordering cost just now. Mm, oops. Okay. Okay. Number 4 is the annual CC or carrying cost. Okay, the formula is this. CC times EOQ divided by 2. The EOQ is 800. The CC is $5. So this is $5 times with your EOQ divided by 2. We get 2,000 as well. Okay. The next one is number 5. There's the total annual inventory cost. So total annual cost is annual CC plus annual CO. So total cost is equal to annual CC plus annual CO And then we can calculate them by NOCC plus NOCO, which is 4,000. 2,000 plus with 2,000. This is the NOCC and NOCO. Oh, sorry. Okay. Number six. Number six is the reorder point. Okay, reorder point. Go back and see. Reorder point is D times L plus with SS. So the D we got already. The L and the SS we haven't found it. So the L is takes 1 week. Okay, 1 week is 7 days. SS, since we haven't found it with we haven't found the SS. Okay, just do D times L first, which is 20,000 times with 7 days. Right. Oh wait. Oh, the D is different right now. So yeah. Remember that D right here is the expected or maximum demand per year and also per units. Sorry, this is per year. So it's each year. It's correct. But for reorder and safety stocks, they are expected a maximum demand. Okay, so they are different per days and also in units. Right here, they say that they are used at the rate of 100 parts, but some days as many as 120. But which one we use? We use the 100. Okay, so 100 times with 7 days. So that one is 700. Okay, for reorder point. With just it, I'll just write it right here. Okay, D is 100 and lead time is 1 week. Or okay, continue to number 7, the safety stock. Safety stock is D times D minus RU times L. So the D is still the same. Wait. Okay. So right here, the demand, we can see that it's using 100 times D, but sometimes they say sometimes it's 120. So the demand sometimes can be higher. That's why we take 120 minus 100. Okay, 100 for. Meanwhile, for the last one is reorder point with safety stock. So this is the point where we use the safety stock. So this one, let's just say that this one is okay. Let's just say it's like this. But for this one, it's different. The 140. So this one, okay. Or as simple as if you want to find with safety stock, you can find it as well as like this. But it's not very recommended for this lah. It's using 120. So it's still the same, but I wouldn't recommend this. I'll more recommend this. Okay, and we are done. And we're done for number 3. And that is all for this module. If you have any questions, you can chat me directly or ask me during the class. Thank you and see you in the next module.